Who's buying and who's selling? Well, the market's higher for a reason. And that's because China is now buying, but they're not buying in the US anymore. They're buying in Shanghai. The Shanghai market has taken over 40% of the open interest in the whole precious metals complex. So that's a changing of the guard. This is where we were in gold 16 months ago. If silver settles above 35 by the end of June, there's no legacy levels of people to go, oh, I'm going to sell it at 39.3. There's none of that shit. It's going to be just pure price discovery.
Hello, everyone. Welcome back to the Daily Gold YouTube channel and the Daily Gold podcast. Thank you so much for tuning in. This is being recorded on the afternoon of Tuesday, June 3rd, 2025. And with me today for our usual monthly wrap-up, he is Vince Lanci. You know him. He is a professor of corporate finance at the University of Connecticut, and he's also the editor and publisher of the very popular GoldFix on Substack. And Professor, as we get started here, let's get right to it. First things first, let's talk about gold. And periodically, I'd like to ask you about this. I'm really curious, who's doing the buying in the gold market now? Has there been any change since the period when gold was correcting at the end of last year and it ended basically right at the start of this year? Steady move in gold up above 3,000, all the way up to nearly 3,500, or maybe it was 3,500. And so now gold to me looks like it's consolidating. And so I'm curious, the players in the market who are buying, has that changed? How is that changing right now? Because in this consolidation, as I like to say, every time we get a nice pop in gold, a nice sudden pop, like Monday, for example, I'm really curious who's coming into the market, who's doing the buying. So enough of me with a long-winded question here. Let us know what you think.
Well, thanks for having me back. And obviously, I love doing this every month with you. That's actually an important question because the dynamic of the market changed going into the end of last year, coming into the current environment that we're in. And by that, two things actually changed. One was the buying for all of 24 was a mix of, well, it was a mix of hedge funds and the bigger hedge funds. And the selling had been banks and other funds. So the market was kind of rotating higher. And it was largely American firms buying into strength. And China was underpinning it. So you had central bank buying from China, and then later in the year you had insurance companies that were mandated to buy, that are mandated to buy gold, stepping in. And then not after the election, but after the new year, after Trump stepped in office, it became apparent, even before he actually implemented them, it became apparent that tariffs were going to be on his agenda. You know, people started to realize that he meant what he said. And a, a couple things significantly changed in the dynamic of who was buying and selling, and both in terms of cohorts, you know, is it a hedge fund, is it a bank, and internationally, who was buying and selling. So there's like a drama within the players that we always look at, you and I always look at, and then there's another drama that's unfolding globally, and it's a secular change in the dominance in the market. I am referring to China taking over pricing. Now, I don't know if it's going to be forever, but China has asserted their dominance in driving price in this market, higher or lower. So to answer your question specifically, so do it before and after, right? So before inauguration and after, or before tariffs and after tariffs, right? Not April. So look at middle of January, right? So before, you had American and international macro discretionary hedge funds buying it, and they were driving it higher. And underneath that, you had China's central bank buying, sovereign wealth fund buying, and you had a late joiner, but important joiner was Chinese insurance companies. So you had these buyers underpinning the market, and you had your bullion banks, which are generally the guys that are generally short. They're always selling it if it's rallying. That's part of their market making duties. The dealers, right? The bank dealers. But the market just kept going up. After, we'll just call after Trump's tariffs become obvious, you had the dynamic changed. And the dynamic changed significantly as to who was buying and selling. So in the when the tariffs became apparent, which also, by the way, it coincided with all that gold and silver being pulled into the US, right? So it coincided with that. Everyone stateside or who had a position was concerned about positioning themselves before the eventuality of tariffs. And what happened during that time frame is the macro discretionary guys, the funds who've been buying it, it's going to go up, we're buying it, it's going to go up. They turned seller, and they didn't sell it down. They were selling it in a rally. And who was buying it, I think, was important. And the buyers were bullion banks that were covering shorts. So the dynamic went from funds buying and banks selling to banks buying and funds selling it to them. And what you would call that is the change in dynamic went from greed, which was buying it, the funds, to fear, which was buying it, the banks. So I think the LBMA crisis and the related behaviors to that, with the gold coming to the US, motivated somebody to be very scared of their overextended position, and they bought it. So to answer your question in brief, the behavior of the market from the gold delivery to the US and till say like 2 weeks ago was the banks covering shorts and locking in losses, the funds selling and locking in profits. And now the COMEX is a ghost town. There's no open interest. I should pull that chart up. I don't have it handy, but there's no open interest. It's the open interest is lower than where it was in 22. So there's like no one in the market either way. It looks like it's on the way to being broken. And I've made this case, not hyperbolically, that the COMEX is on its way out. And I don't mean it's going away tomorrow, but I mean that it has to share the stage as a player in the marketplace. Which brings me to the other part of your question, implicitly. Who's buying and who's selling? Well, the market's higher for a reason. That's because China is now buying, but they're not buying in the US anymore. They're buying in Shanghai. The Shanghai market has taken over 40% of the open interest in the whole precious metals complex. So that's a changing of the guard, a passing of the baton, whatever analogy you want to use, whatever metaphor you want to use. But there is a change in dominance as to who's determining pricing. So all the Chinese buying that was implicitly during U.S. hours is actually buying in Chinese hours. So you have growth of the investor class in China. They're buying on top of, so you got central banks down here. We're going to buy it if it goes down here, right? And it did. We'll show that in a chart. Actually, I should show a chart right now. We're talking about that, right? Is that
Yes.
okay?
Go ahead. Yeah.
All right. So there's a gold daily chart, right? And that's a 50-day moving average, and then the thick red line is a 150-day moving average. That's one of your favorites, I understand. So I think you're buying underneath, like is the Chinese buying at the central bank level, and then right above that you have the insurance funds that have to buy in China, and then right above that you have the ETF buyers in China. So you have these buyers just kind of like stepping in front of each other in China, and that used to underpin the gold market in the US. But now the volumes are going there. I'm seeing the American banks operate in China more. I'm seeing the volumes increasing more. And as I just mentioned, the open interest is 40%. So the buyers and the sellers in the US right now are on strike. They're not playing in gold. They're playing in China. So the COMEX market has become kind of like a tail, and the Chinese Shanghai market has become the dog. We have to stay up later at night now. Actually, you're on the West Coast, so you're okay. I have to stay up later now. I have to go to bed at midnight. Anyway, so that's who's playing. To answer your question, there's a big change going on.
Just a quick follow-up on that, Vince. The macro funds, if we see gold consolidate for several more months, is there another, if that happens, or if something else happens, I'm just thinking, is there another point in the market where the macro funds
Yeah.
would come in And I guess the second question would be, of all these players, who has the most buying power? Like, who's the strongest buyer?
Well, I mean, the biggest buyer would be your central bank, but they're also the more patient, right? The the least patient and smallest buyer would be the small American hedge funds or the Shanghai traders, which tend to be very momentum oriented. The sweet spot for people like you and me is the macro discretionary. They have the deep pockets, they're patient, and they're not afraid to step up. They're not afraid to spend a little money because they have a bigger picture thesis in mind. Which brings us to I think what you're asking indirectly, or maybe directly, is what will it take to make these guys come back? Is that a fair question?
Yeah, yeah, that's absolutely fair to say.
And that's that's something I'm struggling with right now, and I'll explain why. If this were any other conversation, we would be talking like this. We'd be saying, well, I think the macro discretionary comes back if we get a weekly, monthly, quarterly high, right? That attracts them. But they have been selling all the way up for, since January. They sold and it dropped, and they sold in the rally. They've been selling, getting out. They've been literally exiting the market. So it's not just a normal let's get out and get our powder dry. It feels like they're leaving altogether. Now, I'm not saying that they are leaving altogether, but I am saying that you don't leave a market that's good, and the gold market is good now. So they're looking at it, and there is a level that bring them back. But here's something that I think is we'll never find out about this publicly, okay? But you'll see it if I'm right as time goes forward. I believe that the COMEX market and the LBMA, the London market, I believe, based on information and observation, I believe that during that squeeze of the gold that came to the US, I'm not sure if everyone knows this, but the London market is a spot market. And that means if you buy gold there in their spot market, you're supposed to get it in 2 days. It's T plus two. And even though they're not going to be straight on what happened, they went from a 2 day delivery market to a 62-day delivery market to a 92-day delivery market. So they added 60 days on a spot market. They essentially made a spot market into a futures market. And they had all kinds of excuses. A semi legitimate excuse, we had to get the gold from the Bank of America. A bullshit excuse they actually said was it's heavy. The lorries are in, like, I mean, it was unbelievable. It's like, flying a plane is hard when you crash, like that was their job. But to stay narrowly on point, I believe, having seen this in the markets before, and I shared this with premium and founders on GoldFix, that when there's a market that's in danger of losing its legitimacy because you can't deliver, because there's a default, because you have a rogue trader who's messing up the market structure, what regulatory agencies will do, and I've been involved in these situations, I have been in the room when this happened. What they'll do is they'll say, whoa, we're having a hard time delivering this gold to America for whatever reason, whether it's how heavy it is or what. And so we need to slow things down. And so the bullion banks were rumored, and I believe it's true, to have essentially defaulted on their obligations because they couldn't deliver in 2 days. I'm going to have, it's like, Domino's Pizza. If it's not there in 30 minutes, you get it for free or whatever their deal used to be. Well, they didn't have the metal available. Is the gold available on Earth? Yeah, it's on Earth, but their gold was triple rehypothecated. It was encumbered. It wasn't available. It was, I've got to borrow from Peter to pay Paul or rob from Paul to pay Peter back. And I think the complex spider web that the LBMA banks wove to keep themselves afloat was unraveling before our very eyes. And I believe, and this is about macro discretionary, believe it or not, this is about macro discretionary. I believe that the regulatory agencies in the US and in Europe said, hold on, let's get everyone liquidating. And they did a liquidation only play. And the liquidation only play was bullion banks have to cover their shorts, and macro discretionary has to get out of its longs. And that's why between here, between here, basically the end of March, the beginning of April, between April 1st and May 1st, net net, you had nothing but bullion banks buying and macro discretionary selling. It's like opposite day. It's like cats and dogs getting along. It doesn't work that way. If bullion banks are losing money, then the hedge funds are going to run them in. But they weren't. They were playing nice. And the reason I bring all this up is because if you're running a fund, a macro discretionary fund, and you're making money hand over fist because you've been long since 23, and you're another fund, your buddy's been long since the beginning of 24, and they're booking profits. And then the government pulls you in and says, again, this is my opinion, right? The government, but I've been there, right? The government says, we need you to liquidate only, which is what they did to the Hunt brothers, which is what they do when there's a crisis. Everybody must go into their corner and liquidate. Well, when you do that, and you're a macro discretionary fund, you thrive on free market behavior. Once a government steps in, remember the government had a good reason to do that if they did, because the LME basically went under because of the nickel trade years ago, right? Or zinc or whatever, or both, whatever it was. The point being is if they wanted to save the market, rescue the brand, they needed to hamper the free market capability. That's how they think, not how I think. And I'm a macro discretionary fund. Believe me, I'm thinking about not trading it anymore. Because if every time you're going to go in and you are right and you get taxed for being right, not being allowed to let your profits run, you think twice about going back. So my conclusion is I believe the macro discretionary and the bigger funds will come back when it suits them. But I believe right now they're reassessing the whole COMEX market. And some of them are trading in Shanghai because there's more liquidity there, because there's lower commissions there, because there's lower clearing costs there, because it's a business. And the US and London have completely screwed their own franchise. So to answer your question, I believe the Western bullion market has been damaged because of the conflict of interest and the agency problems with the LBMA governing their own traders. And as a result, they have scared, at least temporarily, a good portion of the origin business that makes the market run go. And they've scared it away from the West and into Shanghai. Hopefully, it's not permanent, but that's my answer. More than you bargained for.
Okay, well, sticking on the macro discretionary guys, the
Huh?
big money hedge funds as you're talking about. I don't
Right.
want to jump ahead to silver because I know we have other important points to make about silver, but I mean, you outlined all the reasons there why they're not back in the market, at least yet.
Right.
It, yeah, I mean, it's more of a brief question, but I mean, you can expound upon it, of course. Are they look because silver's gone up so much and the gold silver ratio went to above 100? Are those guys at all interested in silver?
Yeah. Yeah, they are. They are. I know you don't want to get into silver yet, but yes, they are, but they're not in it yet. Okay? So yes, they are. So I don't want to make it sound like I'm being Cassandra, but here's what I want to say. You and I, we look at this and we say, we have our conversation. A new monthly high, the gold people will be back. A new monthly high in silver, they'll be back. Will they add to it? Yes. They just won't put as much in as they normally do. And here's my proof, Jordan. If you go back and you look at the volumes on these big days, there were days, multiple days over the last year, where gold would have 20,000 lots of open interest increase. 10,000s were almost semi frequent. Now, so you would have like 10,000 new longs get in and the market goes up. And then over the next 5 days, you'd have another 20,000 get in. And so you had this commitment to the market. You had this, I trust, right? Now, last week, what's the behavior been for gold for the last month? It's been open interest goes up 5,000. The market doesn't follow through. The range traps. It goes down into the hands of the deeper pocketed people that are buying it, but they're not the funds. What I'm saying is we're not getting 10,000 new contracts in the market anymore. We're back to the old school 5,000, and it's disheartening. Will that prevent silver from getting interest? No, not at all. But it will reduce the amount of money that they're putting into it, at least right now. I'm not killing the market. I'm just saying that like you and I, like when we started doing this, you and I would sit down and we go, all right, new quarterly high in gold. And I'd be like, yeah, that's good. And you're like, yeah, that's good. And we'd say, it's going to attract new money. Let's see what happens on the next day. And boom, the new money would come in like clockwork, right? And we would see that repeatedly. We'd make that call for your listeners repeatedly. However, we might not get that in gold this time. We might get new money's coming in, just not as much, and so that's pretty scary. But will they not go into silver because of that? No, they'll go into silver. You don't need as much money to go into silver to make it move. And as we saw yesterday, right?
Right. Okay, I want to circle back to gold before we go back to silver. So I apologize for the lack of transitions here. But you do have a gold chart here on the screen. So would you like to talk about that and wrap up the technicals with gold before we go
Oh
to
yeah, yeah,
silver?
yeah. We could do that. You know what? I think I could give you a graphic representation because you asked who was buying, and I could show you where they were buying. That might be helpful. Um, Give me a second here. Uh,
Sure.
I don't want to. All right.
Yeah,
So
just
so all right. So this whole we're looking at this whole area here, right? All right. So when the market dropped to here, like between April and May, when the whole news was in the market, I noticed the buying here. And this buying, I found out later on, was bullion banks and Chinese insurance companies. They bought 1, 2, 3, 4, 5, 6 days in the market, goes up and down this little range, and then it cracks and it runs into here. Now, who is this buying? Well, this was the bullion banks like Goldman Sachs buying because they saw the buying down here. The buying down here was your central banks in China. So you had Chinese banks buying, bullion banks buying. It cracked there for a day or two. And then you had that dive and swoop to almost $3,100. And that's where the central bank buying was. And the sovereign wealth fund buying was. And that just underpinned the market and we went back up. And then you had, what did you have? This whole sell-off here, that was who I'm giving you who the buyers are. The sellers were when the market came off of here, a couple of banks put out recommendations to sell gold. And so all the funds started selling it and they drove it down here. And then they got their asses handed to them up here. Now we're back above this level. And I say, oh, look at that. Technically speaking, here we are. And this whole structure here was just like an aberration. So here's the market. The market is from here to here. And if it breaks that, we're going higher. And so it broke it, and now it's teasing it back. So there's a situation. So you have central banks buying in here, you have sovereign wealth funds buying in here, and you have bullion banks buying in here. And your sellers up here are, I don't know, but someone is selling it. I suspect producers are back in the market. That's what I suspect. So does that help a little bit?
yeah, that's very helpful. And I'll just my 2 cents on that. We probably talked about this before. The gold producers now, their margins are really spectacular. That they don't
Yeah.
even need them. They don't even need them to move higher. Like if you're running a gold miner and you're not doing that, at least to some, obviously they all have different financials and balance sheets and all of that. But that's not it's not a bad decision right now if you're a gold miner.
No, I mean, if they have any to hedge, I mean, if you're a gold miner, this is like we haven't had a situation like this for gold miners in over 40 years. And here's what I mean: you have gold at highs, you have energy costs that are low and sinking, and you have interest rates that are high. So that allows them to sell gold 2 years out at 36, 3,700 because of the interest rate carry. That's phenomenal. And I can't believe, I mean, I'm sure it's possible, but I can't believe there's any gold miners still in existence that are poorly run, meaning they don't have their financial house in order. So why they underperform, even though they're catching up now, I don't know. But I mean, what's been said to me is that they underperform because they don't have the sizzle, they don't have a PR team, and they consistently have become so conservative with their management that they don't buy their shares back and they don't increase their dividend. And as a result of that, they suffer on the investment side. I guess there's the international risk as well too these days. But this is it's I want to reiterate, and I'm actually paraphrasing what Citibank had said 2 months ago, that gold miners are a once in a 40-year opportunity for them to make money. And why they're not capitalizing on it, I don't know. So it brings back to your point. If they're not hedging here, then they're brain damaged. They have to start hedging to lock in some profits here. I agree.
Okay, now, yeah, getting back to gold, let's talk about the technicals here, or at least I'll give my 2 cents, and you can respond and give your 2 cents as well. I
Sure.
think, okay, stepping back, there's a couple things. First thing is, I talked about the post breakout corrections in gold. So before the current iteration, 6 previous historical breakouts in gold. What happens is you get a big move higher in gold after the breakout. Then you get a correction. In every case, it basically came back to the 200-day moving average or pretty close. And so where
Right.
we are here, the only time it didn't test it was actually, I think, early 2010 when it tested the 150 day. So that's why you have the 150 day there on the chart.
Right. Right.
The other point I would just make quickly is, typically when gold makes an impulsive move in a secular bull market and then it corrects, there's an element of price and time. And again, this isn't every case, but most cases, the price damage is basically done in the first month, or at least the majority of it. And then gold, in terms of
Are you
time,
referring to this? Are you referring to this area here?
yes, yes. And then in terms of time, it can keep going for several months. Like this could keep going for 3, 4, or even 5 more months. Not a prediction. I'm just pointing that out.
Right. Right. Right.
But so we have we have those two things. Gold could continue to consolidate here, while at the same time the 150-day moving average there, which you see in red,
Right.
that is going to catch up pretty quickly. I think that could get to 3,100 sometime in August. So
Right.
again, not a prediction, but gold can continue to consolidate, and like that's not bearish. I mean, if you told me gold would trade between, like, let's just say it trades between 3,300 to 3,500 over the
Right.
next 2 or 3 months, that's a
Right.
super bullish consolidation. I mean, that's
Right.
setting up for a huge
Right.
move higher eventually.
Right. I'm just trying to follow along with you. So here's the bull market. There's your trend for the bull market. Here's what you could call an impulsive move, right? The market gets ahead of its trend, right? And then it makes the low, right? And then then you're saying it could basically chop around for a while here. And to consolidate up here as opposed to down here where your 150 day is really, really, really constructive. And I see what you're saying there.
And
I
especially, just last, sorry to interrupt, last thing, and as time goes on, those moving averages they'll start to catch up to the market, and then you're kind of at a mature point.
right. Then you have a, like you said, time and price. It's interesting that you say that because one of the things that I fully expected is like after this, I was like, okay, they're going to have their way with it. And I was looking at the 200-day moving average. It comes in like, it's very similar, but it
Yeah,
comes out. I was like,
yeah.
huh. And I was saying to subscribers, we can go down to 2,900 and I'm okay. I won't be happy, but I'll be okay. And I was thinking, here's the move, here's the impulse. The whole thing reverses. We stay here, and then we get back up the trend, and we start going again. But to plug into what you're saying, the difference, I think the difference is China, meaning China is not buying down here. China is buying here. And if China is buying here, then your point about this being a much higher consolidation than you would bet on historically is really good. And that's, you know what? Look, central banks all over the world are not done buying gold. They can't stop buying gold. And I mean, this is math, right? If 100% of the world's trade is done in dollars, then central banks only need dollars. If 25% of the world's trade is done in other currencies, and we're moving towards that. Oil is, I think, maybe as high as 15%, depends on who you're talking to, is done in yuan now. Well, then central banks need to own another currency. Do they want to own yuan? Do they want to own rupees? No, they want to own gold because gold's going to guarantee all of it. So central banks must diversify their portfolio out of pure treasuries and into gold. So we've been talking about this for a couple years, and it's been a big deal for on the China sales pitch when you talk about China. But it's not just China anymore. The West is doing it too. They're just not talking about it. You need to have gold to hedge your international risk because the BRICS are doing that internationally, and there's nothing you can do about it. So, to give you an idea, let's put some numbers on it. Depending on who you talk to, central banks on average have about 15% of their reserves in gold. That needs to double, and it will probably double inside of the next 3 years. That kind of doubling adds about, we'll put it in mining terms, every 5% doubles the mining, takes the mining output off. So whatever the mining output is, I'm getting my numbers wrong here, but it comes down to this. It comes down to get from 15% to 30%, they would have to basically speak for all the gold being mined for the next 5 years. And you know what? That's a problem. I mean, if that means all the other gold has to deal with the borrowing and lending and all that other shit. So I'm giving you the story that goes with why we're making a low here and not here. So that's it. I'm in your corner on that. I agree.
Yeah, just two more responses to that. The first thing, and this is in the market. There's a lot, I'm not trying to argue with people who say technicals don't matter, but
Right.
that point is in the market. That's why it looks like it's very possible that gold is not going to come back and test the 200-day as it did basically in 5 out of the 6 post breakout corrections. And the second thing, and I have that chart. I'm going to throw up that chart in post production here, where you're talking about the central banks. Yeah, yeah, 15%, you said? There's a guy on Twitter at Jan Gold, I think his name is, who puts out that beautiful chart. These guys are totally underpositioned. I mean, you might think in the last 3 or 4 years, or 5 years, wow, they've been buying lots of gold. This isn't going to continue. Well, when you look at the percentage of their reserves in gold, it's minuscule. And even if you look at where they were in the 1970s, the last time we had a secular bear market in bonds, it was way higher, way higher.
Yeah.
So yeah, you put all these things together, and then you look at the gold chart, and that's why maybe even I could be wrong about another 2 or 3 month consolidation where the 150-day moving average catches up.
Right. Right. Well, which brings us to silver. If silver has its way, it'll drag gold higher this time. So we
Good
might have it.
transition.
Exactly.
Yeah, good, yeah,
Uh,
good transition.
right. I mean, it feels like silver's leading now. There's the silver 3 month, right? That's your favorite chart. Tell me about this chart, Jordan.
Okay, so this is the quarterly silver chart, and we're not showing the 1980s. We've already closed above the quarterly high, all-time high in 79 or 80. Last quarter we closed above that, so we've taken out that resistance. The end of the quarter is at the end of June, so the next time we do this will be very interesting because the
Yeah.
all-time quarterly futures high close in silver, I believe, is $37.60. Now, the second, third, fourth highest close, you can see there in 2011, 2012. They're like in the 34, 33. They've kind of clustered there. So here's the rub. If silver can close this month above 35, even if it's 35.02 or 35.03, that will be the second highest quarterly close ever. And you can
Yeah.
see where we are right now, that the horizontal thin line there, I think that's the last trade in the
Yeah.
market. And you can see how that lines up with the resistance there, those levels in 2011 or 2012. So, Professor, this is going to get really interesting in 4 weeks from today if we're talking and silver has a 35 handle. And
Yeah.
we've talked about weekly and monthly how significant 35 is. So this quarterly close, this is an important tell for the market to see if
Okay.
I mean, can these guys knock this thing back below 35, or are we
Let's.
going to see it blow through?
Well, I don't know what the answer to that is, but I want to just bring up a situation that we were in almost 2 years ago, maybe 2 years ago, and that conversation was you saying, "Oh, it's the end of the month. We got a monthly close. It's going to be a good close." And we're talking about gold, and we're like, "Oh, it's the end of the week." It was like we had a good. It was a Friday, like end of the week, end of the month, end of the quarter. And you went, "Oh, look, this is a quarterly high. This is a quarterly all-time high for gold," and And we looked at each other and said, macro discretionary is definitely buying next week. And they bought like crazy. So I want to reiterate what macro discretionary looks at, because what you're saying, look, I, if you're a macro discretionary fund, you trade everything on earth. You have a lot of money, you trade everything on earth, and you trade what's moving, and you have a screen, and the screen has everything on earth on it, and you say, and you have things that you trade all the time, bonds, stocks, whatever. And then you say, set an alert. Did anything make a new monthly high? Because then they're going to look at it and maybe trade it. When something makes a new quarterly high, someone will say, yeah, we got a new quarterly high in something for the last 2 years. Oh, really? I'll take a look at it. When your alarm goes off and says new quarterly high, second all-time highest quarterly high in silver, they're in the market the next day. It's on their screen and they're saying, all right, how do we get in? When do we get in? This is what happened in gold. It's happening in silver. It's happening. It's going to happen in silver as you're describing, as I'm describing, if we get a quarterly close over $35. So I'm we're having a deja vu moment, because I said this about gold. Well, I'm sorry, we said this about gold when we had this situation back then. So quarterly close is probably the holy grail for a macro discretionary. An annual close would be the best. Like quarterly, that's also an annual. Okay, well, we'll have to wait 6 months for that. But an annual close, highest all-time annual close in gold, well, that means they're going to trade it, because they have to trade it, because everyone's looking at it. So I think looking at this and listening to you, even though I'm saying to you that the market is damaged, the COMEX, not the market, the venue is damaged. COMEX is in trouble. They're going to buy it. They may not buy it on COMEX. They may buy it in China, but they're going to buy it, Jordan. They're going to buy it. It's like the headline is basically 35 gets you, I don't know what the headline is, but it has a quarterly close over 35, and it's going to be lights out for anyone who's not fucking in this market. That's what I think. So I agree. I mean, we had this conversation about gold a year ago, Jordan, like 18 months, 14 months ago. So we're having the conversation again, and now it's about silver. It might be silver's turn.
Yeah, and just to add color for people, once you get by 35 and then 37 in silver, I mean there is like, I don't want to say no resistance, but there's almost no resistance from 37 to 50. Like it's totally minimal. So silver has been fighting and clawing and chewing its way through all this supply from 26 to 35, and now it looks like it's getting really close. I'm not going to say it's going to, break out tomorrow or next month or next quarter, but I mean, this is getting really close. And the other thing, Professor, I don't know if I'm jumping ahead too soon to the stocks, but it's not just with the gold stocks and the miners leading gold. Like you're seeing it in silver. I know that silver is it's such a smaller, tiny market. I mean, I don't want to give individual names because those are for subscribers only, but
Right.
there's two juniors that to me are like the two best silver juniors. And those were making new high, like the last week. I mean, they broke out to higher highs, basically. And so, and you look at other stocks. I mean, even today, before we got on, I was looking at the stocks again, and you have white candles in all these junior silver stocks, even though silver's down today. I mean, I know
Right.
it's just one day, but Professor, more money is coming into the market, and yeah, I really think that the not only the gold stocks are leading gold now, but I think the silver stocks they're leading this breakout through 35, because we're not going to see a thing where it's like the silver stocks are waiting for silver to get to 37 or 40.
Well,
They're already.
that's my cue to bring up the silver juniors
Yeah,
chart, your
yeah,
silver juniors
yeah.
chart, right? So should I do that? Should I do that?
Yes, go ahead.
Let's
Yeah.
bring that up, right? I mean, that's where we are now. All right. So I brought a couple of charts for me because we were talking about this beforehand. But there's silver daily, right? So silver daily it looks like a breakout when you look at this narrow time frame. And in fact, this is what it looks like to me. It's like a conga line that got broken, and the consolidation below 35, is the only thing that's left. The consolidation is broken. But now we get to your point about, has silver broken out yet? And you had said to me, No, it's not. And so there's the three rectangles. There's the weekly chart. We've got a high in November of 24. We've got a high in March of 25. And now we're touching up against that same high in the 35 area. To your point, all this work underneath 35, all these times that the market has been rejected. I don't know that it can be rejected anymore. But that then we get to the main event here. Silver, there's silver juniors, right? That's your silver juniors chart. Does that
Yes.
show up?
The
Yeah,
SILJ ETF. Yes, I see
yeah,
that.
yeah. Yeah. It's funny because I was in a chat with my subscribers the other day, and someone asked me the question that you're answering implicitly. And like for example, the rally in silver the last 2 days, that was short covering. That wasn't fresh money coming into silver. Okay, I'm sure there was some fresh money coming in, but it was short covering because all the CTAs going back since the beginning of time have been selling silver and buying gold because they wanted to own precious. And then they've been selling silver and buying copper because they wanted to own industrial. And silver just sits in the middle there, kind of like an unloved stepchild with these CTAs. But they're morons genetically. I mean, they're disciplined is what I mean. They hedge their risk. And so when silver cracked, whatever it cracked, for whatever reason, they all covered, like the wildebeest or herding, pack animals that they are. And the reason, this is what I had said to my subscribers. And they were like, what about miners? And right away, I knew the answer. I'm like, the miners are not shorts covering. There's fresh interest, and the miners have been doing better. Like it was only one day where silver spiked compared to the miners. The silver miners, and I don't have a lot of exposure in that, have been outperforming silver, even while silver was in that stupid little Congo line. Should I put that chart up? That's something we were talking about, right?
Yeah, yeah, go ahead. Yeah, go ahead.
Here it is. So I don't know if everyone could see this, but that this is Jordan. This is to Jordan's point. The burgundy line is silver. The blue line is the silver junior miners, and that's going back since like November of last year. So what am I looking at here?
Or is the burgundy, is that the SILJ divided by silver?
No, no, no. I'm putting them separately. I'm putting them separately. All right. So the burgundy line is silver, and the blue line is the silver juniors. It's not a division. It's a separate market. So
Okay,
I'm showing
okay.
them as separate markets. Yeah, yeah.
Well, if we can see if we actually go back, this is very good because you can see the beginning of the year. But if you look at what happened after the mini stock market crash in April, you can see how the before April, from January to April or January through March, we can see that the silver juniors, the blue line, was behind the burgundy the whole time. But since then, what's happened? Now the blue line, not the entire time, but we're seeing several instances where it's running ahead of silver, the red line. And in the last 3 days or so, way ahead. Even before we had the big pop on Monday, look at the blue line last week, just surging above the red line. Yeah, right
Right.
there.
In fact, that's a good point. Here. What are we looking at over here? Between here and here, this is what I see. I see the blue line and the red line tracking each other, but the blue line is more volatile, right? So it's like, silver goes up a little, it goes up a lot. Silver goes up a little, it goes up a lot. And then silver obviously goes up a little, goes up some, and it goes up a lot. And then silver drops a lot and it, dives out of an airplane, right? Okay. But then the behavior changes when the market resettles here, meaning silver goes up a lot and the juniors don't really move. But then silver drops and the juniors stay in a range. So then the market was very wide in volatility and it gets narrower and narrower. So it's like completely unrelated markets, very volatile. Something snaps here and the market starts to get tighter, right? The blue line starts to track the red line. And now the blue line, like you said here, overtakes it. And as silver's doing this, the miners are doing that. And that's fresh money. That's the money that we're looking at here. That's like the miners are leading now. This is the whole American investor psyche is changing. Now, they're going to go back into the Magnificent Seven. It's going to be a story that won't die because all the banks are long it. But the miners are what's happening now. It really is it. That's it. So I see. I mean, this is crazy. This is crazy, right? Even like, look at this. When silver went up that much, the miners went up, looks like about 150% of the move, right? Okay. So now you have silver going up a massive move, but the miners are going up. Here we go. Here we go. Silver goes up from 8% to 13%. Put a number on it. So let's call that 5%. During that same time frame, the miners go up 13%, up 20%. So it's 5% in silver equals 8% in the miners. That's crazy. I mean, it's not crazy. It's normal. People have forgotten what normal is. It's a it's a good market.
Yeah, and to me, this is, I don't have super scientific data behind this, but if you're early in a new cyclical bull market in precious metals within a secular bull,
Yeah.
again, we don't have tons of examples, but what I've seen is after that first move higher, what happens is before the second leg higher, gold is so much farther along than everything else that, naturally, because it's outperformed, the other things don't sell off as much after the first run. And a big reason for that is so much more money is waiting to come in the market because they missed the
Yeah.
first move. And so all
Right.
that money now, yes, we're looking at gold and again, looking at gold, okay, this needs to consolidate, it needs the moving averages to catch up. But the miners and now silver and silver stocks, I mean, they're just completely ignoring that. They're, because more money is coming in the market. And if you look at those ETF charts that Callum Thomas posts on Twitter, there's been nothing in the last couple of months. I mean, there's been some money, some big money starting to come into the sector, but this is first inning stuff, guys. Like this is going to run for a couple of years. This is not just like a 2 or 3 month story.
Yeah, that's it's funny you bring that. Like there are two parallels that I could add to that. I'll talk about China and central bank buying has been underpinning the gold market for the last 2 years, raising the floor. While the money in the metals miners now is waiting for a dip to buy. So that's going to raise the floor on that as well. The market is going to continually, I believe, gradually rise over time. And the other point you're making about the ETFs, yeah, ETF money. How about this? ETFs are a reflection of American investor interest. I believe that American investors, they started to come back into ETFs, but they've actually kind of, like you said, fizzled out over the last month or so. I don't think it's American investors buying the miners. I think it's the big banks positioning for the next big thing. I think they're getting ready. And American investors, there's only like two banks that have put out commentary that are remotely positive on the miners recently. One's RBC, but they're always talking about miners, right? The other one was, so I'm not even going to count them. Citibank put out that report about 2 months ago, it was phenomenal. And Bank of America made the case as well. And I believe the biggest, smartest money is positioning themselves right now. Like, we're not at the top. If we're right, we could be wrong. We're not at the top. We're at the beginning of the rotation. It's going to be crazy. Anyway, that's it.
Professor, is there another chart that we missed, or should we wrap things up?
Let me roll through here. Hold on. We'll give everyone a quick preview. So we did that one, right? We did that one. There's the conga line. That's just a sign for me that the market's going to move higher. There's the same chart. There's silver. There's gold. No, we got them all. We got them
We
all.
covered that. Yeah, I guess last thing we can go back to the weekly one there. Maybe I could just make one or two more comments.
What with the rectangles?
Yeah, the weekly one.
Wait, hold on, hold on.
The silver one.
Wait. There it
Yeah,
is.
that one. I mean, for me, and I think I mentioned this a week or two ago, seeing gold silver rally up to nearly 35, that to me is a really good sign. And you mentioned it, several minutes ago. This is going to break out at some point. I mean, you could go back. I'm just being in general. You don't have to take the screen back, but
Yeah.
if you look at the last 2 years of action, silver like 3 or 4 times, it was contained at 28, 29. Now it's gotten above it. It's retested. You can see it in the chart there. It's retested 28, 29, basically 3 major times in the last year on the weekly chart. And the conga line, that consolidation, yeah, that was a mini breakout, and that just tells me the fact that it broke above there, and now it's touching 35. It didn't fall below your line there. I mean, that's telling me it's going to break out sooner rather than later. It's just, it's supply and demand, the market. It's chewed through a lot of resistance. 1, 2, 3 failures at 35. Now you had the stock market mini crash, rallied all the way back up. I mean, it's in position. I mean, I guess, master of the obvious here, but I mean, this thing's going to break out. It's going to break 35 sooner rather than later.
Here's the new silver chart. There you go. Smiley face. Above 35, we're very happy. There you go. All right. I agree, man. That's it. That's good. Yeah. I mean, look, I just want to bring it back to the point that I mean, I wasn't thinking about this before, and so it kind of just dawned on me. This is where we were in gold, like, 16 months ago, where we were going, oh, look at that. It's a daily, it's a weekly, it's a quarterly, it's a monthly, it's a, whatever. It's a forever all-time high. And I was like, oh yeah, this is really kind of cool. Jesus, macro discretionary has to buy that. And you know what? They're going to buy it. If silver settles above 35 by the end of June, then
it's the second highest quarterly close ever.
yeah, but 40 calls will be cheap. And to your point about there's not a lot of resistance in between there, I'm sure there will be at some point, but there's no legacy levels of people to go, oh, I'm going to sell it at 39.3. There's none of that shit. It's going to be just pure price discovery.
All right, sounds good. Professor, anything else we need to cover? Anything
No,
else we missed?
No, I love the fact that you call me professor, but call me Vince now. All right. I mean, I enjoy that, but only my students call me that. No, I'm kidding. But I appreciate it. I appreciate it. I don't think there's anything else to talk about except that Bank of America said something recently, and it basically said they think gold's going to 4,000. Everyone says that now. It's almost boring. But they said they think silver's going to lead this time. So they called for silver at $40 before gold at 4,000. So this all could be playing into our hands, into our greedy little hands. Mind you, I am long silver right now, speculatively speaking. So my position is definitely telling me what I want the market to do. I'm ready. Let's make it happen.
Vince, before we close here, please tell our listeners here, our viewers as well, where they can go to follow you and, more importantly, subscribe to GoldFix.
Yeah, GoldFix. I have a Substack newsletter, goldfix.substack, GoldFix, goldfix.substack. And you can find me on Twitter. I'll give you my Twitter handle. It's Soren the K. But sign up for GoldFix free, and you'll probably get a couple emails a day, and you'll decide if you want to get involved more. We cover institutional analysis. We cover bank analysis. We cover actionable ideas. It's a very big tent with regards to precious metals. And we cover geopolitical and macro drivers behind those markets. So that's it. I look forward to seeing you.
All right. And I'll just mention, if you subscribe to GoldFix, there's not much else you have to read on the gold market on a day-to-day basis, because Vince and GoldFix, they cover it all. Vince, thanks as always. And I'm really looking forward to next month, and we'll see if silver can bust above 35.
It could be. It could be. I think it's the time. Thanks for having me, Jordan.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.